Your Money. Joining me now is Key Advisors Wealth Management CEO, Eddie Ghabour. Also with us is Ryan Payne this morning. Eddie, good to see you. Thank you so much for joining the conversation. I want to get your take on markets.
Thanks for having me.
Final trading day of September, final trading day of the third quarter. Amazing that it is the third quarter ending already. All three major indices were higher yesterday, but they are pulling back this morning. Yesterday, shrugging off uncertainty of a potential government shutdown. Markets, of course, on a tear this year. The Nasdaq up 17% year-to-date. The S&P 500 up better than 13% year-to-date. And the Dow up about 9% so far, all or largely fueled by the AI tech boom. Meanwhile, the White House is releasing details on new tariffs going into effect on October 14th. There will be a 10% tariff on imported lumber, a 25% tariff on kitchen cabinets, vanities, and upholstered furniture. On January 1st, cabinets and vanities tariffs could double to as high as 50%, while upholstered wood products will jump to 30%. And then there's this going into effect tomorrow, 100% levies on pharmaceutical companies who are not manufacturing in America. Eddie, Jefferies analyst Michael Yee called out Amgen and Biogen as having the greatest exposure to tariffs among the biotech companies that he covers. You know, most people feel that AbbVie, Bristol Myers, Squibb, and Eli Lilly appear well-positioned because they already have manufacturing footprints in the U.S. So what's your take on all of these tariffs coming, as well as expectations for the fourth quarter?
Well, I think expectations for the fourth quarter are going to continue to be strong. We have been saying to our clients that this is one of the best setups we've seen in nearly 30 years from a market perspective. And I think one thing we've learned this year is this administration is very transparent with what they're going to do and when. So you just have to be in the right sectors with the right companies, because tariffs, we've learned, have no impact in regards to the market if you're in the right areas. We learned that here early in the year. And at the end of the day, if we take a step back as investors, this AI boom is very similar to the internet boom in regards to where markets are going to go. And I think valuations in the market will be much stronger than it was in the 90s, because we have a Fed that's going to be cutting interest rates at a time when I think the economy is going to really start to accelerate late fourth quarter and going into the first half of 2026. So it is rare to get opportunities like this. So we have grossed our risk up, because we know when this run does end, our firm will sell. We will not tell our clients to ride it out. But in the meantime, you want to go where the money flows are. And right now, the trend is your friend. You don't want to fight the Fed. And the Trump administration's pro-growth policies are just going to be getting started. So it's a great time to be an investor right now.
And so you want to buy going into the new quarter?
Absolutely. We're going to get pullbacks. We know we're not going to be going straight up, but I think you just need to go. And with this rotation trade, we talked about it for months now, and it's really starting to catch legs going into discretionary names, small caps, financials.
Ryan, do you agree with that?
Yeah, I think it's a very healthy bull market. I think Eddie's completely right. We are starting to see this bull market spread out. And I think if you think about growth is accelerating. In fact, this quarter, we're looking at 3.9% GDP growth, which is like off the charts. That's more than historical average. So anything that's like cyclical or is tethered to the economy, like Eddie just mentioned, small caps are a great place to be. And there's so many places that trade cheap versus the Magnificent Seven. And I see this with everyone's portfolios. People are just over-levered to that Magnificent Seven trade. There's lots of great places to put your money right now.
What about oil? Oil lower this morning, Ryan. OPEC Plus considering another increase in output in November. To be discussed at this upcoming Sunday meeting, the Trump administration announced a $625 million investment into America's coal industry this week. I spoke with Energy Secretary Christopher Wright, who broke the news on this program here yesterday. Watch.
We're announcing today expanded programs to help the American coal industry. It's our third largest source of electricity after natural gas and nuclear, but we also use it. It's the backbone of steel production. It's critical for cement production. Coal just makes the world go round, and they've tried to strangle it, particularly the Biden administration, starting with the Obama administration. But we need the coal industry. We're stopping the strangulation. Coal's got a long future. Let's stop pretending it's going away, or stop wishing it was going away. It's critical to our country.
So the Department of Energy announcing a $625 million investment to expand and reinvigorate the industry. and try to boost energy production and support communities that have these coal plants.
Coal is a huge part of our electricity grid today. We're going to use it for American industry, particularly as we reindustrialize, and it's going to continue to provide 15–16% of our electricity and enable us to reindustrialize and win the AI race.
Ryan, how do you invest around all of that?
I think all the energy names right now are relatively cheap. I mean, if you look at specifically old school oil, but I think, look, the point here is we need to feed this AI boom because if you look at us versus China, they're producing like 20% more primary energy than we are on an annual basis. And we may have the best technology in the world, and we do when it comes to AI infrastructure. But if we can't feed it with electricity, you know, that's a big, big problem. So I think this is really a push for that. And I also like the fact that buying energy stocks is kind of like AI adjacent, right? There's other places to put your money that's not specifically AI that trades a lot cheaper. So I think if you're going to play it here, Maria, I think I would definitely look at energy stocks here, specifically anything that's like fossil fuels. Look at oil this morning. It's down again. So it's probably a good time to buy these stocks for the long term. You're getting fat dividends, again, low valuations. And we know we're going to have a lot of energy demand over the next 5 to 10 years. So I think it's a good time to position yourself while the prices are low.
Yeah, I mean, the energy demand is coming as a result of data centers and this AI boom. I want to get your take on how the Fed plays into that, Eddie. Look at interest rates this morning. We've got a lot of information out this week on the macro story. Jobs data. We've got the August JOLTS report out today at 10 a.m. Eastern. The September ADP numbers out tomorrow morning, where economists are expecting 50,000 private sector jobs added. And then the September jobs report out on Friday, where 50,000 jobs created are expected. The unemployment rate expected to hold steady at 4.3%. Of course, we've got to add that the Labor Department is warning that the jobs report may not even come out if the government shuts down at midnight, Eddie. Your reaction and expectation to the macro story?
So I think the Fed is going to continue to hang on their hat on the labor market weakening, okay? And there's a difference between weakening and going into a recession. We're not anywhere close to a recession. And the other important point is I think they've thrown this 2% inflation out the window. They won't admit it, but they're not going to get to 2%. So this weakening labor market is just what the bulls needed, because the last piece to this puzzle was the Fed starting to cut rates. So I think they're going to continue to cut rates well into next year. And whether they cut 2 times this year or 1 more time, I think investors need to understand the trend for Fed policy is loosening policy. And when you increase liquidity, when the economy is accelerating, that is very bullish for risk assets.
All right, we will leave it there. Eddie, great to have you. Come back soon. Ryan, you're with us all morning long, and we're so grateful for that.